Not all wealth advisors are looking out for your best interest. They could actually be working against you because most investors don't realize the system is built on hidden fees, kickbacks, and sales disguised as advice. I'm going to expose what you need to be looking out for in this video. Step number one, the difference between a broker and a fiduciary advisor. Did you know that amongst financial advisors, there's two different kinds? The first and the most common, 89% of financial advisors are brokers. They get paid to sell stuff, meaning they work for a brokerage house and that company's gonna have investment products that they're interested in selling you. The broker's job is to line you up with their company and make sure that that product is a good fit. It's no different than essentially saying, I'm looking for a new car, and you show up at Ford. What are you gonna get? A Ford. They're not there to sell you GM, Tesla, or something else. In addition to that 89% that's brokers, there's an 11% that are registered under the Investment Advisors Act of 1940. Those are investment advisors. Investment advisors do not get paid to sell stuff. They're typically going to work for smaller firms, independent firms, and they're there to sell their advice. So unlike that broker that's looking to sell investments like mutual funds, annuities, life insurance, they don't really have anything that they're selling. They're selling their advice. They're putting themselves in your shoes and they're saying, if I had your money, this is what I would invest in. If you're looking for a broker, you're looking to buy something, my suggestion would be go interview a bunch of them and know ahead of time what you want to buy and that they're going to sell it to you. If you're looking for a financial advisor, look for a registered investment advisor, somebody that's going to be a fiduciary. They're going to put themselves in your shoes and recommend something that they would use themselves. Step number two, most companies will push certain types of preferred products. This can happen even when your broker or registered investment advisor tells you, hey, we have everything available, right? Just because they have everything available does not mean that that person uses everything that is available. They may have certain kickbacks or arrangements with their company to make more money on certain investments than others, or they might have relationships with certain fund families or asset managers that they're trying to push. If, let's say, for example, you go to a company and you find that there's a lot of mutual funds from one fund family, or that all the products seem to be kind of clustered around a certain theme, like maybe they're all insurance or maybe they're all annuities, right? One of the things you got to ask yourself is that really a company that you want to be with? Is this company more focused on kind of falling in love with their strategy, or are they going to listen to you as a client and do what's in your best interest and be passionate about what your goals are and look at how their strategy might help you and complement versus trying to fit you into the box that they've already built. Number three, avoid alternatives like the plague. Alternative investments are complex, usually high cost, very opaque investments that are usually sold under the disguise of exclusivity. Hedge funds, private equity funds, investments that lock you up like real estate investment trusts that are private. It sounds like it's a good thing. You know, hey, I'm giving you this thing that nobody knows about, wink, wink, right? I'm giving you this investment that you can't get anywhere else. Avoid those. It's a lot of smoke and mirrors. I can tell you I've lost hundreds of thousands of dollars investing in alternatives thinking that these people knew something I didn't. If it has a huge minimum, if it has a large fee, if you can't get out of it for a couple of years, say no thank you and move on. At Verde, we have a no BS philosophy. No fake exclusivity, no opaque investments, nothing that locks you up. Everything that we want to invest in are things that you can get out of tomorrow if you need to. We don't want anybody here to stay here because they feel like they're stuck. You should be able to leave if you need to, and any investment that sticks you in for a long time should not be part of your portfolio. Last step, look at a grading system for your money. Most financial advisors have no benchmark to be able to grade themselves. Now, this is pretty funny because we send our kids to school so that we know where are they strong, where could they improve, what do we need to focus on? But with financial advising, there's really no good benchmark, universally accepted benchmark that tells you, hey, this is exactly how you're doing. Are you above average, below average in your return? I ask people this all the time in meetings. They're like, well, I don't really know what's good. We've pioneered something here called the Verde average investor return. We actually took the data from every mutual fund, every ETF, every separately managed account that you could buy inside the United States. And we took all those and compiled them into one investor, over $40 trillion of assets. And what we can tell you from that is how that average investor is performing, meaning half of the people are doing better than this, the other half are doing worse. If you're working with a financial advisor and you're not doing better than the average investor, you need to ask yourself, why are you paying for below average returns. Last year, for example, I could tell you that the average investor inside the United States made a 12.98% return. Go take a look at your statements. Look at your 401k plan. See, are you above that number? Are you below that number? Maybe you take on less risk than the average investor. Maybe you decided to buy into the market when it was really low versus somebody that bought in when the market was high. We can dissect further to find out why, but the important thing is to have some benchmark, and that way you can start to really bring a lot of attention to how do I get above the average. The Verde average investor return is a benchmark that you can count on for being able to see that. Now that you know who not to trust, let me walk you through a strategy you can trust. One that worked out for our clients over market cycles and could work for you too.